Accountancy. Financial Statements, 2-9. In Chapter 8, you learnt about the preparation of simple final accounts in the format of trading and profit and loss account and balance sheet. The preparation of simple final accounts presupposes the absence of any accounting complexities which are normal to business operations. These complexities arise due to the fact that the process of determining income and financial position is based on the accrual basis of accounting. This emphasizes that while ascertaining the profitability, the revenues be considered on earned basis and not on receipt basis, and the expenses be considered on incurred basis and not on paid basis. Hence, many items need some adjustment while preparing the financial statements. In this chapter we shall discuss all items which require adjustments and the way these are brought into the books of account and incorporated in the final accounts. 9.1 Need for adjustments. According to accrual concept of accounting, the profit or loss for an accounting year is not based on the revenues realized in cash and the expenses paid in cash during that year. There may exist some receipts and expenses in the current year which partially relate to the previous year or to the next year. Also, there may exist incomes and expenses relating to the current year that still need to be brought into books of account. Such items duly adjusted, the final accounts will not reflect the true and fair view of the state of affairs of the business. Learning objectives. After studying this chapter, you will be able to describe the need for adjustments while preparing the financial statements. Explain the accounting treatment of adjustments for outstanding and prepaid expenses, accrued and advance receipts of incomes. Discuss the adjustments to be made regarding depreciation, bad debts, provision for doubtful debts, provision for discount on debtors. Explain the concepts and adjustment of manager's commission and interest on capital. Prepare profit and loss account and balance sheet with adjustments. Rationalized 2023-24 financial statements, 2-319. For example, an amount of $1,200 paid on July 1, 2016 towards insurance premium. Any general insurance premium paid usually covers a period of 12 months. Suppose the accounting year ends on March 31, 2017, it would mean that 1/4 of the insurance premium is paid on July 1, 2016 relate to the next accounting year 2017-18. Therefore, while preparing the financial statements for 2016-17, the expense on insurance premium that should be debited to the profit and loss account is $900, $1,200, $300. Let us take another example. The salaries for the month of March 2017 were paid on April 7, 2017. This means that the salaries account of 2016-17 does not include the salaries for the month of March 2017. Such unpaid salaries is termed as salaries outstanding, which have to be brought into books of account and is debited to profit and loss account along with the salaries already paid for the month of April 2016 up to February 2017. Similarly, adjustments may also become necessary in respect of certain incomes received in advance or those which have accrued but are still to be received. Apart from these, there are certain items which are not recorded on day-to-day basis, such as depreciation on fixed assets, interest on capital, etc. These are adjusted at the time of preparing financial statements. The purpose of making various adjustments is to ensure that the final accounts reveal the true profit or loss and the true financial position of the business. The items which usually need adjustments are: 1. Closing stock; 2. Outstanding expenses; 3. Prepaid, unexpired expenses; 4. Accrued income; 5. Income received in advance; 6. Depreciation; 7. Bad debts; 8. Provision for doubtful debts; 9. Provision for discount on debtors; 10. Manager's commission; 11. Interest on capital. It may be noted that when we prepare the financial statements, we are provided with the trial balance and some other additional information in respect of the adjustments to be made. All adjustments are reflected in the final accounts at two places to complete the double entry. Our earlier example in Chapter 8, page No. 294, which represents the trial balance of Ankit, is reproduced in Figure 9.1. Rationalized 2023 to 24,320 accountancy. Trial balance of Ankit as on March 31, 2017. Account title elements LF Deb. We will now study about the items of adjustments, and you will observe how these adjustments are helpful in the preparation of financial statements in order to reflect the true profit and loss and financial position of the firm. 9.2 Closing stock as per the example in Chapter 9, page No. 336. The closing stock represents the cost of unsold goods lying in the stores at the end of the accounting period. The adjustment with regard to the closing stock is done by I. by crediting it to the trading and profit and loss account, and E. by showing it on the asset side of the balance sheet. The adjustment entry to be recorded in this regard is closing stock A, C drive. To trading A, C, the closing stock of the year becomes the opening stock of the next year and is reflected in the trial balance of the next year. The trading and profit. Rationalized 2023-24 financial statements, 2/321. And loss account of Ankit for the year ended March 31, 2017, and his balance sheet as on that date shall appear as follows. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive CR. Expenses, losses amount, revenues, gains amount. Purchases 75,000, sales 125,000, wages 8,000, closing stock 15,000, gross profit C, D 57,000. 140,000, 140,000. Salaries 25,000, gross profit B, D 57,000, rent of building 13,000, commission received 5,000, bad debts 4,500, net profit transferred to 19,500, Ankit's capital account 62,000, 62,000. Sometimes the opening and closing stock are adjusted through purchases account. In that case, the entry recorded is as follows: closing stock A, C drive. To purchases A, C, this entry reduces the amount in the purchases account and is also known as adjusted purchases, which is shown on the debit side of the trading and profit and loss account. In this context, it may be noted that the closing stock will not be shown on the credit side of the trading and profit and loss, as it has already been adjusted through the purchases account. Not only, in such a situation, even the opening stock will not be separately reflected in the trading and profit and loss account, as it is also adjusted in purchases by recording the following entry: purchases A, C drive. To opening stock A, C. Another important point to be noted in this context is that when the opening and closing stocks are adjusted through purchases, the trial balance does not show any opening stock. Instead, the closing stock shall appear in the trial balance, not as additional information or as an adjustment item, and so also the adjusted purchases. In such a situation, the adjusted purchases shall be debited to the trading and profit and loss account. Rationalized 2023 to 24,322 accountancy. The closing stock shall be shown on the asset side of the balance sheet as shown below. Balance sheet of Ankit as at March 31, 2017. 100 long-term loan. 9.3 Outstanding expenses. It is quite common for a business enterprise to have some unpaid expenses in the normal course of business operations at the end of an accounting year. Such items usually are wages, salaries, interest on loan, etc. When expenses of an accounting period remain unpaid at the end of an accounting period, they are termed as outstanding expenses. As they relate to the earning of revenue during the current accounting year, it is logical that they should be duly charged against revenue for computation of the correct amount of profit or loss. The entry to bring such expenses into account is concerned expense A, C drive. To outstanding expense A, C, the above entry opens a new account called outstanding expenses, which is shown on the liabilities side of the balance sheet. The amount of outstanding expenses is added to the total of expenses under a particular head for the purpose of preparing trading and profit and loss account. For example, refer to Ankit's trial balance, refer figure 10.1. You will notice that wages are shown at $8,000. Let us assume that Ankit owes $500 as wages relating to the year 2016-17 to one of his employees. In that case, the correct expense on wages amounts to $8,500 instead of $8,000. Ankit must show $8,500 as expense on account of wages in the trading and profit and loss account and recognize a current liability of $500 towards the sum owed to his staff. It will be referred to as wages outstanding and it will be adjusted to wages account by recording the following journal entry: wages A, C Dr. 500 to wages outstanding A, C 500. Rationalized 2023-24 Financial Statements, 2-323. The amount of outstanding wages will be added to wages account for the preparation of the trading and profit and loss account as follows. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive C. For prepaid expenses, there are several items of expense which are paid in advance in the normal course of business operations. At the end of the accounting year, it is found that the benefits of such expenses have not yet been fully received. A portion. Rationalized 2023 to 24,324 accountancy of its benefit would be received in the next accounting year. This portion of expense is carried forward to the next year and is termed as prepaid expenses. The necessary adjustment in respect of prepaid expenses is made by recording the following entry: prepaid expense A, C drive. To concerned expense A, C, the effect of the above adjustment entry is that the amount of prepaid part is deducted from the total of the particular expense, and the new account of prepaid expense is shown on the asset side of the balance sheet. For example, in Ankit's trial balance, let us assume that the amount of salary paid by him to the employees includes an amount of $5,000 which was paid in advance to one of his employees upon his joining the office. This implies that Ankit has overpaid his staff by $5,000 on account of his salary. Hence, correct expense on account of salary during the current period will be $20,000 instead of $25,000. Ankit must show $20,000 expense on account of salary in the profit and loss account and recognize a current asset of $5,000 as an advance salary to the employee. It will be termed as prepaid salary account and will be recorded by the following journal entry: prepaid salary A, C Dr. 5,000 to salary A, C 5,000. The account of prepaid salary will be shown in the trading and profit and loss account as follows. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive CR. Expenses, losses amount, revenues, gains amount. Purchases 75,000, sales 125,000, wages 8,000, closing stock 15,000, add outstanding wages 508,500, gross profit C, D 56,500. 140,000, 140,000. Salaries 25,000, gross profit B, D 56,500 less prepaid salary 5,000, 20,000 rent of building 13,000 commission received 5,000 bad debts 4,500 net profit, transferred to Ankit 24,000 capital account. 61,500, 61,500. Rationalized 2023-24 Financial Statements, 2-325. Observe how the prepaid salary has resulted in an increase of net profit by 5,000 making it as 24,000 further. The item relating to prepaid salary will be shown in the balance sheet on the assets side as follows. Balance sheet of Ankit as at March 31, 2017. Liabilities amount, assets amount. Owners funds, non-current assets capital 12,000, furniture 15,000, add profit 24,000, 36,000, current assets, non-current liabilities, debtors 15,500, long-term loan 5,000, prepaid salary 5,000, current liabilities, bank 5,000, cash 1,000, creditors 15,000, closing stock 15,000, outstanding wages 500. 56,500, 56,500. 9.5 Accrued income. It may also happen that certain items of income such as interest on loan, commission, rent, etc. are earned during the current accounting year but have not been actually received by the end of the same year. Such incomes are known as accrued income. The adjusting entry for accrued income is accrued income A, C drive. To concerned income A, C, the amount of accrued income will be added to the related income in the profit and loss account, and the new account of accrued income will appear on the asset side of the balance sheet. Let us, for example, assume that Ankit was giving a little help to a fellow businessman by introducing few parties to him on commission for this service. In the trial balance of Ankit, you will notice an item of commission received amounting to 5,000. Assume that the commission amounting to 1,500 was still receivable from the fellow businessman. This implies that income from commission earned during 2016-17 is 6,500, 5,000 plus 1,500. Ankit needs to record an adjustment entry to give effect to the accrued commission as follows. Accrued commission A, C Dr. 1,500 to commission A, C 1,500. Rationalized 2023 to 24,326 accountancy. The account of accrued income will be recorded in trading and profit and loss account as follows. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive CR. Expenses, losses amount, revenues, gains amount. Purchases 75,000, sales 125,000, wages 8,000, closing stock 15,000, add outstanding 500, 8,500, gross profit C, D 56,500. 140,000, 140,000. Salaries 25,000, gross profit B, D 56,500 less prepaid salary, 5,000, 20,000 rent of building 13,000 commission received 5,000. Add accrued 1,500, 6,500. Bad debts 4,500 commission net profit, transferred to 25,500 Ankit's capital account. 63,000, 63,000. Observe that the accrued income has resulted in an increase in the net profit by 1,500 making it as 25,500. Further, it will be shown in the balance sheet of Ankit on the assets side under the head current asset. Balance sheet of Ankit as at March 31, 2017. Liabilities amount, assets amount. Owners funds, non-current assets capital 12,000. 6. Income received in advance. Sometimes, a certain income is received but the whole amount of it does not belong to the current period. The portion of the income which belongs to the next accounting period is termed as income received in advance or an unearned income. Income received in advance is adjusted by recording the following entry: concerned income A, C drive. To income received in advance A, C, the effect of this entry will be that the balance in the income account will be equal to the amount of income earned for the current accounting period, and the new account of income received in advance will be shown as a liability in the balance sheet. For example, let us assume Ankit has agreed in March 31, 2017 to sublet a part of the building to a fellow shopkeeper at $1,000 per month. The person gives him rent in advance for the next 3 months of April, May and June. The amount received had been credited to the profit and loss account. However, this income does not pertain to current year and hence will not be credited to profit and loss account. It is income received in advance and will be recognized as a liability amounting to $3,000. Ankit needs to record an adjustment entry to give effect to income received in advance by way of following journal entry. Rent received A, C Dr. 3000 to rent received in advance A, C 3000. This will lead a new account of rent received in advance of $3,000 which will appear as follows. Balance sheet of Ankit as at March 31, 2017. Liabilities amount, assets amount. Owners funds, non-current assets, capital 12,000, furniture 15,000, add net profit 25,500, 37,500, current assets, non-current liabilities, debtors 15,500, long-term loan 5,000, prepaid salary 5,000, current liabilities, accrued commission 1,500, creditors 15,000, bank 5,000, outstanding wages 500, cash 4,000, rent received in advance 3,000, closing stock 15,000. 61,000. Rationalized 2023 to 24,328 accountancy. 9.7 Depreciation. Recall from Chapter 7, Part 1, that depreciation is the decline in the value of assets on account of wear and tear and passage of time. It is treated as a business expense and is debited to profit and loss account. This, in effect, amounts to writing off a portion of the cost of an asset which has been used in the business for the purpose of earning profits. The entry for providing depreciation is Depreciation A, C drive. To concerned asset A, C in the balance sheet, the asset will be shown at cost minus the amount of depreciation. For example, the trial balance in our example shows that Ankit has a furniture account with a balance of $15,000. Let us assume that furniture is subject to a depreciation of 10% per annum. This implies that Ankit must recognize that at the end of the year the value attached to furniture is to be reduced by $1,500, 15,000 times 10%. Ankit needs to record an adjustment entry to give effect to depreciation on furniture as follows. Depreciation A, C Dr. 1,500 to furniture A, C 1,500. Depreciation will be shown in the profit and loss account and balance sheet as follows. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive CR. Expenses, losses amount, revenues, gains amount. Purchases 75,000, sales 125,000, wages 8,000, closing stock 15,000, add outstanding wages 500, 500, gross profit C, D 56,500. 140,000, 140,000. Salaries 25,000, gross profit B, D 56,500 less prepaid salary 5,000, 20,000, rent of building 13,000, commission received 5,000, 6,500. Add accrued 1,500. Depreciation furniture 1,500, commission bad debts 4,500, net profit transferred to 24,000 Ankit's capital account. 63,000. Notice that the amount of net profit declines with the adjustment of depreciation. Let us now see how depreciation as an expense will be shown in balance sheet. Rationalized 2023-24 financial statements, 2,329. Balance sheet of Ankit as at March 31, 2017. Liabilities amount, assets amount. Owners funds, non-current assets, capital 12,000, furniture 15,000, add profit 24,000, 36,000 less depreciation 1,500, 13,500 non-current liabilities, current assets, long-term loan 5,000, debtors 15,500, current liabilities, prepaid salary 5,000, creditors 15,000, accrued commission 1,500, outstanding wages 500, bank 5,000, rent received in advance 3,000, cash 4,000. Closing stock 15,000, 59,500, 59,500. 9.8 Bad debts. Bad debts refer to the amount that the firm has not been able to realize from its debtors. It is regarded as a loss and is termed as bad debt. The entry for recording bad debt as bad debts A, C drive. To debtors A, C, you will notice in Ankit's trial balance that it contains bad debts amounting to 4,500. Whereas, the sundry debtors of Ankit are reported as 15,500. The existence of bad debts in the trial balance signifies that Ankit has incurred a loss arising out of bad debts during the year and which has been already recorded in the books of account. However, assuming one of his debtors who owed him 2,500 had become insolvent, and nothing is receivable from him, but the amount of bad debts related to the current year is still to be accounted for. This fact appears as additional information and is termed as further bad debts. The adjustment entry to be recorded for the amount will be as follows. For this purpose, Ankit needs to record an adjustment entry as under Bad debts A, C Dr. 2,500 to debtors A, C 2,500. This entry will reduce the value of debtors to 13,000, 15,500, 2,500, and increases the amount of bad debts to 7,000, 4,500 plus 2,500. Rationalized 2023 to 24,330 accountancy. The treatment of further bad debts in profit and loss account and balance sheet is shown below. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive CR. Expenses, losses amount, revenues, gains amount. Purchases 75,000, sales 125,000, wages 8,000, closing stock 15,000, add outstanding wages 508,500, gross profit C, D 56,500. 140,000, 140,000. Salaries 25,000, gross profit B, D 56,500 less prepaid salary 5,000, 20,000 rent of building 13,000 commission received 5,000. Add accrued 1,500 6,500 1,500 commission. Depreciation, furniture bad debts 4,500 add further bad debts 2,500 7,000 net profit, transferred to 21,500 Ankit's capital account. 63,000 63,000. Balance sheet of Ankit as at March 31, 2017. Liabilities amount, assets amount. Owners funds, non-current assets, capital 12,000, furniture 15,000, add profit 21,500 33,500 less depreciation 1,500 13,500 non-current liabilities, current assets, long-term loan 5,000, debtors 15,500. Less further bad debts 2,500 13,000. Current liabilities and provisions, prepaid salary 5,000, creditors 15,000, accrued commission 1,500. Bank 5,000. Outstanding wages 500, cash 4,000. Closing stock 15,000. Rent received in advance 3,000. 57,000 57,000. 9.9 Provision for bad and doubtful debts. In the above balance sheet, debtors now appears at 13,000, which is their estimated realizable value during next year. It is quite possible that the whole rationalized 2023-24 financial statements, 331 of this amount may not be realized in future. However, it is not possible to accurately know the amount of such bad debts. Hence, we make a reasonable estimate of such loss and provide the same. Such provision is called provision for bad debts and is created by debiting profit and loss account. The following journal entry is recorded in this context: Profit and loss A, C drive. To provision for doubtful debts A, C provision for doubtful debts is also shown as a deduction from the debtors on the asset side of the balance sheet. Let us assume, Ankit feels that 5% of his debtors on March 31, 2017 are likely to default on their payments next year. This implies he expects bad debts of $650, 13,000 times 5%. Ankit needs to record the adjustment entry as Profit and Loss A, C Dr. 650 to provision for doubtful debts A, C 650. This implies that $650 will reduce the current year's profit on account of doubtful debts. In the balance sheet, it will be shown as a deduction from sundry debtors. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive CR. Expenses, losses amount, revenues, gains amount. Purchases 75,000, sales 125,000, wages 8,000, closing stock 15,000, add outstanding 508,500, gross profit C, D 56,500. 140,000, 140,000. Salaries 25,000, gross profit. It may be noted that the provision created for doubtful debts at the end of a particular year will be carried forward to the next year and it will be used for meeting the loss due to bad debts incurred during the next year. The provision for doubtful debts brought forward from the previous year is called the opening provision or old provision. When such a provision already exists, the loss due to bad debts during the current year are adjusted against the same, and while making provision for doubtful debts required at the end of the current year is called new provision. The balance of old provision as given in trial balance should also be taken into account. Let us take an example to understand how bad debts and provision for doubtful debts are recorded. An extract from a trial balance on March 31, 2017 is given below. Sundry debtors 32,000, bad debts 2,000, provision for doubtful debts 3,500. Additional information: write off further bad debts 1,000 and create a provision for doubtful debts at 5% on debtors. Rationalized 2023-24 financial statements, 333. In this case, the following journal entries will be recorded. Debit credit. Date particulars LF amount. March, bad debts A, C Dr. 1031, 2017 to sundry debtors 1000, further bad debts. B, provision for doubtful debts A, C Dr. 3000. 9.10 provision for discount on debtors. A business enterprise allows discount to its debtors to encourage prompt payments. Discount likely to be allowed to customers in an accounting year. Rationalized 2020. 24,334 accountancy can be estimated and provided for by creating a provision for discount on debtors. Provision for discount is made on good debtors which are arrived at by deducting further bad debts and the provision for doubtful debts. The following journal entry is recorded to create provision for discount on debtors. Profit and loss A, C drive. To provision for discount on debtors A, C as stated above, the provision for discount on debtors will be created only on good debtors. It will be calculated on the amount of debtors arrived at after deducting the doubtful debts, i.e. 12,350, 13,000, 650. Ankit needs to record the adjustment entry as Profit and Loss A, C Dr. 227 to provision for discount on debtors A, see 227. This will reduce the current year profit by 227 on account of probable discount on prompt payment. In the balance sheet, it will be shown as a deduction from the debtors account to portray correctly the expense. In the subsequent year, the discount will be transferred to the provision for discount on debtors account. The account will be treated in the same manner as the provision for doubtful debts. 9.11 Manager's Commission. The manager of the business is sometimes given the commission on the net profit of the company. The percentage of the commission is applied on the profit either before charging such commission or after charging such commission. In the absence of any such information, it is assumed that commission is allowed as a percentage of the net profit before charging such commission. Suppose the net profit of a business is 110 before charging commission. If the manager is entitled to 10% of the profit before charging such commission, the commission will be calculated as 110 times equals 11. Rationalized 2023 to 24,336 Accountancy. In case the commission is 10% of the profit after charging such commission, it will be calculated as equals profit before commission times rate of commission, 100 plus commission. The manager's commission will be adjusted in the books of account by recording the following entry: Profit and Loss A, C Drive. To manager's commission A, C, let us recall our example and assume that Ankit's manager is entitled to a commission at 10%. Observe the following profit and loss account if it is based on I. Amount of net profit before charging such commission, E. Amount of profit after charging such commission. I. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive CR. Expenses, losses amount, revenues, gains amount. Purchases 75,000, sales 125,000, wages 8,000, closing stock 15,000, add outstanding wages 508,500, gross profit C, D 56,500. 140,000, 140,000. Salaries 25,000, gross profit 56,500 less prepaid salary 5,000, 20,000 rent of building 13,000 commission received 5,000. Add accrued 1,500 6,500 1,500 commission. Depreciation, furniture bad debts 4,500, add further bad debts 2,500 7,000, provision for doubtful debts 650, provision for discount on debtors 227, managers commission 2,062, net profit transferred to 18,561, Ankit's capital account 63,000. Rationalized 2023-24 financial statements 337. Balance sheet of Ankit as at March 31, 2017. Liabilities amount, assets amount. Owners funds, non-current assets, capital 12,000, furniture 15,000, add net profit 18,561, 30,561 less depreciation 1,500, 13,500, non-current liabilities, current assets, long-term loan 5,000, debtors 15,500. Less further bad debts 2,500. 13,000. Less provision for current liabilities and provisions doubtful 650, creditors 15,000, debts 12,350. Less provision for discount on debtors 227, 123. Outstanding wages 500, prepaid salary 5,000, rent received in advance 3,000, accrued commission 1,500. Bank 5,000, cash 4,000. Managers commission 2,062, closing stock 15,000, outstanding 56,123, 56,123. E. Trading and profit and loss account of Ankit for the year ended March 31, 2017. Drive CR. Expenses, 12. Interest on capital. Sometimes, the proprietor may like to know the profit made by the business after providing for interest on capital. In such a situation, interest is calculated at a given rate of interest on capital as at the beginning of the accounting year. If, however, any additional capital is brought during the year, the interest may also be computed on such amount from the date on which it was brought into the business. Such interest is treated as expense for the business, and the following journal entry is recorded in the books of account: interest on capital A, C drive. To capital A, C in the final accounts, it is shown as an expense on the debit side of the profit and loss account and added to capital in the balance sheet. Let us assume Ankit decides to provide 5% interest on his capital. This shall amount to 600, for which the following journal entry will be recorded: interest on capital A, C Dr. 600 to capital A, C 600. This implies that net profit shall be reduced by 600. As a result, the reduced amount of profit shall be added to the capital in the balance sheet. Rationalized 2023-24 Financial Statements, 2-339. But, when interest on capital shall be added to the capital, this effect shall be neutralized. As shown below. Capital 12,000, add profit 17,961. 29,961. Add interest on capital 600. 30,561. Test your understanding. Tick the correct answer. 1. Rahul's trial balance provide you the following information: debtors 80,000, bad debts 2,000, provision for doubtful debts 4,000. It is desired to maintain a provision for bad debts of 1,000. State the amount to be debited, credited in profit and loss account. A. 5,000 debit. B. 3,000 debit. C. 1,000 credit. D. None of these. 2. If the rent of 1 month is still to be paid, the adjustment entry will be: A. Debit outstanding rent account and credit rent account. B. Debit profit and loss account and credit rent account. C. Debit rent account and credit profit and loss account. D. Account. 3. If the rent received in advance 2,000. The adjustment entry will be: A. Debit profit and loss account and credit rent account. B. Debit rent account credit rent received in advance account. C. Debit rent received in advance account and credit rent account. D. None of these. 4. If the opening capital is 50,000 as on April 1, 2016, and additional capital introduced 10,000 on January 1, 2017. Interest charge on capital 10% P. A. The amount of interest on capital shown in profit and loss account as on March 31, 2017 will be: A. 5,250. B. 6,000. C. 4,000. D. Rs. 3,000. 5. If the insurance premium paid 1,000 and prepaid insurance 300. The amount of insurance premium shown in profit and loss account will be: A. 1,300. B. 1,000. C. 300. D. 700. Rationalized 2023 to 24,340 Accountancy. Adjustment entry: treatment in trading, treatment in and profit and loss balance sheet account. 1. Closing stock A, C Dr. shown on the credit shown on The. To trading A, C asset side and profit asset side. And loss account. 2. Outstanding expense A, C Dr. added to the shown on the expenses to outstanding respective expense liabilities side. Expense A, C on the debit side. 3. Prepaid expense A, C Dr. deducted from the shown on the unexpired to expenses A, C respective expense on asset side expenses the debit side. 4. Income earned occurred income A, C doctor added to the shown on the but not received to income A, C respective income assets side. On the credit side. 5. Income received income A, C doctor deducted from the shown on the in advance to income received respective income liabilities. In advance A, C on the credit side sides. 6. Depreciation depreciation A, C doctor shown on the debit deducted from. To assets A, C side the value of asset. 7. Provision for profit and loss A, C doctor shown on the debit shown as bad and to provision for side deduction doubtful debts from debtors. 8. Provision for profit and loss A, C doctor shown on the debit shown as discount on to provision for side deduct when debtors discount debtors form debtors. 9. Managers doctor shown on the debit shown on the commission A, C side liabilities side. To outstanding commission A, C. 10. Interest on capital A, C doctor shown on the debit shown as capital to capital A, C side addition to capital. 11. Further bad debts A, C doctor shown on the debit deducted from debts to sundry debtors A, C side debtors. Fig. 9.2. Showing treatment of various types of adjustments. Rationalized 2023-24 financial statements, 2-341. Debit balances amount credit balances amount. Drawings 6,300 capital 150,000 cash at bank 13. Key terms introduced in the chapter. Outstanding, accrued expenses, prepaid, unexpired expenses, accrued incomes, income received in advance, depreciation, bad debts, provision for doubtful debts, provision for discount on debtors, manager's commission, interest on capital. Summary with reference to learning objectives. 1. Need for adjustments. For the preparation of financial statements, it is necessary that all the adjustments arising out of the accrual basis of accounting are made at the end of the accounting period. Another important consideration in the preparation of final accounts with adjustments is the distinction between capital and revenue items. Entries which are recorded to give effect to these adjustments are known as adjusting entries. 2. Outstanding expenses. At the end of the accounting period, sometimes a business enterprise is left with some unpaid expenses due to one reason or another. Such expenses are termed as outstanding expenses. You are required to I. Redraft the trial balance. E. Prepare final accounts for the year ended March 31, 2017 after giving effect to the following adjustments. A. Taxes are paid for 10 months only. B. Creditors worth = 780 have accepted bills payables. C. Depreciate furniture by 10%. D. Trucks were depreciated to the extent of = 21,000. A. Wages includes = 2,000 for the making of furniture. F. Closing stock is of = 20,000. G. Provide for manager's commission at 10% on the net profit before charging such commission. H. Land was acquired on the 1st of April 2016 by paying a claim at 50% less than market value to the owner. E. Name the accounting principles which will be followed